Hello, this is EPI Advisors. We would like to share the most significant big data changes as of January 2024. The most crucial aspect of 2024 has been the scenario planning following the Federal Reserve's interest rate cuts. Historically, after a rate cut, the stock market usually shows positive results, but during economic downturns or issues, there can be a 20 to 25% decline. Therefore, this year, it's not just the rate cut that's important, but also the proactive response needed post-cut. Firstly, regarding the economy, this year is marked by numerous elections in various regions and countries, including the US and South Korea, highlighting the inextricable link between politics and economics. The Biden administration in the US is significantly intervening in the economy with fiscal policies comparable to those during World War II. The global financial crisis (GFC), and the COVID-19 pandemic. Secondly, Federal Reserve Chair Powell is rapidly withdrawing liquidity, with the M2 money supply relative to GDP at an unusually high level before tightening. Consequently, neither President Biden nor Chair Powell can further supply liquidity. This has led to a state where personal savings have entered a negative realm, revealing a situation where individuals can no longer save but are drawing on their savings. Let's see how the market is reflecting the withdrawal of liquidity from the economy. The conclusion from this page is that the market seems to be in its most defensive phase. The assets on the left are risk assets. The assets on the left are stocks, divided into the US and non-US. However, funds have shifted to non-risk assets like bonds and MMFs, which are liquidity assets. So, most of the money is flowing into non-risk assets. According to experts, including global fund managers, about the changes in asset allocation between November and December. They reported buying banks and selling tech stocks, as well as buying European assets and selling American ones. This indicates a different pattern of asset rotation and profit realization than what we previously understood. The pattern of buying assets that have declined significantly and selling those that have risen emerged. This trend can be attributed to behaviors following the global financial crisis (GFC) of 2007. Post-GFC, global investors sold assets to raise cash during critical periods, demonstrating a need for liquidity. These periods include the onset of credit risk in China, the first interest rate hike after quantitative easing, and the outbreak of COVID-19. Each time, securing liquidity became a recurring issue. The current market trend seems to be moving towards a similar phase. So let's take a look at how asset prices reflect the burden of this liquidity tightening. The impact of liquidity tightening on asset prices, particularly in the stock market, a key financial asset, is influenced significantly by the size of government debt. The part marked in sky blue represents the scale of U.S. government debt, and the black part corresponds to the Dow Jones Industrial Average in the U.S. Both appear to be near their peak, indicating a rapid rise followed by a decrease in potential for further growth, as shown by the data. In the bond market, experts predict that U.S. policy rates could drop to 3% by 2025, indicating the possibility of over a 2% rate cut in the future. This view of the bond market, along with the behavior of stocks, shows a pattern different from what we have observed in the past. In the physical market, such as commodities, this trend is consistent. Commodities necessary for certain industrial productions, like palladium, and commonly used raw materials such as oil, have experienced significant price drops. Ironically, the price of gold performed well in 2023, likely influenced significantly by inflation. Considering the current market conditions reflected in asset prices, we aim to provide ideas on how to select and allocate assets. The key principle shown in this chart is how the S&P 500, a major U.S. stock index, compares to the limit of debt scale, what percentage it represents. The market appears favorable as the stock market cap has increased or marginal debt has decreased, positioning it better than the trend. However, deviating from the long-term trend suggests a potential regression, leading to either a decrease in market cap or an increase in marginal debt, both now plausible scenarios. It's essential to consider the possibility of a shift from positive to negative trends. The bond market's movements can be broadly divided into two perspectives. Firstly, the opinions of the US FOMC members and the dot plot results suggest about 3 rate cuts. On the other hand, market experts anticipate up to 6 cuts. 6 cuts in 2024 would be nearly double what the central bank expects, indicating a significant difference between the central bank and market experts' views. If the central bank changes its stance, it could create a substantial investment opportunity in the bond market. In 2023, stock and bond markets showed unexpected trends, challenging preconceptions about specific countries and the overall economy. Countries like Brazil, Poland, and Argentina surpassed the US in stock market growth, contrary to common expectations. Did these countries all lower their interest rates? No, they did not. Argentina raised interest rates significantly, while China lowered them but saw stock prices fall. This suggests that assumptions about stock performance based on interest rate changes were often incorrect. It highlights the need to question our biases in 2024, as the economic cycle may continue to defy expectations. The capital markets fund flow, with 60% now in passive investments like ETFs and index funds managed by machines, indicates a shift from traditional human-managed funds. Understanding the market dynamics driven by both human and machine-managed funds is crucial. Preconceptions, like stock prices rising with falling interest rates, need reevaluation. Similarly, in bond selection, the possibility of 6 rate cuts should be examined with big data analysis. This highlights the importance of adapting to the evolving nature of fund management and market trends. AI learns from both rational and emotional data, with rational data typically enhancing investment performance and emotional data potentially detracting from it. Prioritizing areas for AI learning can significantly improve investment outcomes. We'll continue to update and share new insights on stock and bond selection logic as market biases are challenged. If machines trained with data uncover new information that could shift directions, we will release another videos to share these findings.